The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A drama-filled week for investors comes to a relatively undramatic end. From Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
I'm Alex Steele. Sleepy Friday. Friday?
Well, it doesn't have to be like an F. You need like
I know.
Freaky Friday.
I don't know. I don't have it.
Flip-flop Friday.
Are we flip-flopping? That's the point. This is just a board of showing you know what? Everything's okay. Everything's calm, at least now into Friday. Volume is also really, really light here with the S&P up by about 0.4% off the highs of the session nonetheless. VIX calming down, money flowing back in the 10-year, so no more spike in rates, no more sell-off in equities, and no more spike in the VIX. Does it last, Romaine? Yeah, well, that's the big question here. We could call it that gradual return to calm in what is still going to go down as the most volatile stretch of equity and bond market sessions of the year. But despite the extreme moves, the S&P is poised to end the week actually right around where it started, believe it or not. And Bank of America's Michael Hartnett, he says the turbulence didn't quite reach proportions that reflect expectations for a hard economic landing. Now, that sentiment actually dovetails with comments that we got out of Kansas City Fed President Jeffrey Schmidt, who signaled he's not ready to support a cut in interest rates given what he sees as a still healthy labor market. Swap traders also further trim bets on aggressive Fed easing, and 4/5 of economists surveyed by Bloomberg predict that the Fed's first rate cut in 4 years will be a modest quarter-point move. David Miracle, the chief U.S. economist over at Goldman, is just fine with that.
They ought to be, and I think they will, erring on the side of caution if we do get additional negative data. I'm not really concerned at all about inflation staying too high.
Now, economic perceptions could be challenged next week when we get another read on the consumer with earnings from Walmart and Home Depot, among others. Remember, investors and economists alike were rattled this week by warnings out of companies like Disney of slower business at its theme parks, a warning by Airbnb that bookings growth is decelerating, a warning from Capri that its apparel brands are struggling with shrinking margins. And we also got soft guidance, believe it or not, out of makeup company Elf Beauty. I mean, if makeup can be touched, then what? Nothing's safe.
This goes against everything I believe in. Invest in your face. This totally shocked me. All right, listen, if you were on vacation from last Thursday at 3 p.m. till now, you know what? You didn't really miss much. Yes, we are down for 4 straight weeks in a row on the S&P. We haven't seen that since September of 2023. But just look at how we are almost back to neutral, despite the tumultuous weeks that we've seen up until then. So basically, rewind a month and you're kind of good to go, Romaine. I think the question is this a response to technical selling, so sort of leverage unwind, the carry trade, et cetera, or is this a fundamental economic growth scare? Because that will depend on what kind of positions you wind up taking as we go forward.
Absolutely. As we kick you off to the close, let's bring Lisa Shalett into the conversation, CIO over at Morgan Stanley Wealth Management. And that is a question that I think you kind of have to parse, Lisa, when you look back, not just this week, but of course what happened last week here. Was that really fundamentally driven, or was it something a bit more technical? Sorry, I think we're having some audio issues with Lisa right now. We'll try to get Lisa's connection sorted out here. But Alex, when we talk about this crazy week, and you saw gold basically come close to reclaiming its record high, you saw one of the biggest point gains in the VIX that we've had since the existence of the VIX. And I think we have Lisa's audio issues fixed now. Thanks for being patient with us, Lisa. And we talk about all these extremes, all these superlatives that we've seen over these last 5, 6, 7 sessions here. What do you think was really driving that?
So, we've been in the camp that a lot of this was a technical unwind of, some speculator trades, whether we talk about, the yen carry trade, or we talk about a short volatility trade. I know this sounds like a lot of jargon for a lot of your audience, and it certainly does for a lot of our clients. But the reality is that while some of the macroeconomic data certainly did come in a little bit weaker than folks hoped, certainly in the labor market and for some of the manufacturing data, the reality is the U.S. economy is slowing. But nowhere near recession. And earnings, by and large, are coming in okay. consistent with a soft landing. And that's what we need to continue to focus on, is that a soft landing is just that. It is a landing. It is a material slowdown from what had been a very, very strong expansion phase.
Yeah.
We're going to avoid recession, avoid negative growth, but we're going to be below average growth. And just the path to getting there is bumpy.
Well, I hope Jay Powell is watching this, Lisa, because right now the drumbeat coming out of the markets and even from some of the other Fed members that you need to cut big, and you need to do it sooner rather than later. Here, I mean, if we are seeing effectively what is kind of the makings of a soft landing, what do you think the monetary response needs to be, if there needs to be one at all, at this moment?
We're in the camp that says the Fed has been appropriately measured. They've been appropriately data driven. As I said, the data is mixed. We got good data on services. And I think that the Fed is going to proceed with caution. They've given forward guidance. They're going to start in September. It's probably going to be 25 basis points. And that is the right thing against a backdrop where we're coming out of a second quarter where United States GDP growth on a real basis was 2.8%, which is quite healthy.
So, Lisa, Romain was talking about gold. Where do you go for safety when things are bumpy?
We like gold a lot, and we also like other real assets. So we include, in addition to gold, right now we're buying things like energy infrastructure assets. We're buying residential real estate linked assets like the residential REITs. Those are all areas that we think are relatively safe. And our favorite place to be at this point is investment grade credit. We are in the sweet spot for investment grade credit, where you're not too hot, you're not too cold, you're able to clip coupons with corporate cash flows remaining very robust.
Lisa, it's interesting you bring that up, because this week we saw record issuance in investment grade. We didn't have a blowout spread situation that would have implied a VIX at, say, 60 or 65. Do you think that is yet to come or not?
We are in the camp that there's still a lot more volatility that is probably going to play out this summer. There's just too many unknowns. There had been way too much complacency in this market. And so our best guess is that while volumes are low now, as people come back from vacation, there are still portfolios that are out of position that will continue to unwind as we get into the post-Labor Day fall period.
All right. Well, there were a lot of catalysts this week that moved the market, including the macro, but also a lot of concerns about tech. We want to continue that conversation in just a second, but we need to take a break. Lisa's still sticking with us, CIO at Morgan Stanley Wealth Management. We'll be back in a moment. This is Bloomberg.
Shares of Cisco are down by about 0.4%, reportedly cutting 4,000 more jobs in a second round of layoffs this year. That's according to a report from Reuters, in order to double down on its faster-growing businesses like cybersecurity and AI. Woo Jin Ho over at Bloomberg Intelligence joins us now. Woo Jin Ho, you knew that they hadn't cut enough back when they announced it in February. Is this enough? Will they do enough with these cuts?
Yeah, Alex, when they cut last time at around 5%, I almost felt like they were trying to do a wait and see in terms of where the recovery is going to go. That recovery really never materializes, or didn't materialize as strongly as I had hoped. And I thought it was going to be another 5 to 10% on top of that. And the sense I'm getting right now is that this 5% should satisfy some investors, hopefully when they report next Wednesday.
What's the growth story, Woo Jin? Is there one?
That's a good one, Romain. In terms of organic growth, look, they're going through going through a rough patch that's been lasting a little bit over 6 quarters now. They have another couple of quarters of weakness in terms of the organic growth. But the traditional networking business, look, it's a 0 to 5% grower longer term. But there is an attractive AI story. Keep in mind, they acquired Splunk a couple of quarters back, and that part of the business plus security should grow around mid-teens. Now, 2025, fiscal 2025 is a transition year in my mind. But if everything really comes into place, the growth story gets a little bit more attractive. But we're not talking about double-digit growth here anytime soon. We're talking about mid-single-digit growth at best for now.
Right, versus say other tech companies that are in the AI chip sector and forget about it. Woo Jin Ho, we appreciate it. Bloomberg Intelligence for joining us on that. Let's get more with Lisa Shalett, a CIO at Morgan Stanley Wealth Management. Lisa, Truist said, you know what? Time to buy tech. Excess has been wrung out. Investor expectations have reset lower. Let's buy tech. What do you think?
Well, I don't know that all the excess has been wrung out. That might be a little bit of an exaggeration. But certainly valuations are much closer to fair value and much closer, to 5-year medians. So what we're telling clients is, for those who are very, very underweight tech, who, were waiting for an opportunity, this is an okay entry point. But certainly we would not be going overweight or chasing names here because they're really not that oversold. We've had a pullback. And one of the things that I think is important to note is that certainly with some of the semiconductor names, we're starting to be reminded that these great secular growth stories are exciting, but they are also exposed to global and cyclical factors. And so I think, the memory of 2022 and some of the tech earnings recession that we had then has faded quickly from people's memories. But I think, we're reminding investors that tech earnings can be very vulnerable to economic slowing, and there's a lot of operating leverage in some of their margins.
Well, when we talk about all the spend that we've seen out of the corporations, meaning like the hyperscalers and other folks who are buying the chips and other data servers and things needed to sort of power this sort of AI fever dream, if you will. When you looked at some of those reports, Lisa, did anything strike you as outsized in terms of the amount of spending, or did it seem like, at least based on the promise, that it was more, I guess, commensurate with what it takes to get there?
Look, this is a super hard question to answer. It's the supply versus the demand question. And look, the hyperscalers, I believe, to my ears, have been very, very clear that they want to spend ahead of demand assessments. They want to be there. They are not hyper concerned right now about the timing of return on investment. And those are the types of things typically that can lead to overbuilds and excess capacity down the road. So look, I don't think we're there this quarter or next quarter, but these are issues that are going to have to be confronted in the next year or two. And the conversation with the investment community has just begun.
Yeah, Lisa, because it's still a cyclical business. Like, it's still chips. It's still a cyclical business in a structural shift. If we see more carry trade unwind, how exposed do you think we'll be to another tech sell-off?
Quite. By our best guess, we're only about 60% through the carry trade unwind. Remember, a huge amount of capital has come out of Japan and flowed into U.S. equity markets, has flowed into U.S. Treasury markets. And so, as those dollars are both repatriated and short trades covered, there is vulnerability to the things that were most crowded. And that includes, some of the tech stocks and the ones that dominated, quite frankly, even the vanilla S&P 500 index.
Hey, we only have time for one last quick one here, Lisa. And I do want to get your thoughts here about the upcoming election and whether you expect to see a shift in the trade out there around that election. And by that, I essentially mean, are people going to move to the sidelines until they get clarity on it?
Well, I think our biggest fear with regard to the election is, less that we're going to have some outcome that necessitates policy changes. I think that always happens. I think our concern is that it drags on. We're going through a historic era where the belief in the sanctity of American elections is being questioned. And so what we don't want to have happen is, come out of November 5th with lots of uncertainty, lots of court cases, lots of litigation. Those are the types of things that if that scenario played out, rather than, whether we have a red or a blue win, is the one I think would be most damaging to the United States stock markets.
All right, Lisa, always wonderful insights, always a great conversation. Wishing you a great weekend. Lisa Shalett, CIO over at Morgan Stanley Wealth Management, kicking us off to the close here on this Friday afternoon. And it's weeks like this one where stocks for the long run takes on a whole different meaning. Jeremy Siegel, Professor Emeritus of Finance over at Wharton, going to be joining us later in the program.
Plus, shares of Elf Beauty taking a hit today, even after posting sales that topped even the most bullish Wall Street estimates. We're going to break down the moves in today's stock of the hour.
And some big moves in the real estate space. Billionaire buying spree, if you will. Larry Ellison buying a posh, well, what else would it be? Luxury hotel down in the same Palm Beach enclave where he dropped over $170 million on a residential compound 2 years ago. A lot to talk about. Stick with us. This is The Close on Bloomberg. All right, time now for our top calls. The big movers on the back of analyst recommendations. And we start off today with Five9. The cloud software company downgraded to neutral from outperform over at Baird. The analysts also slashing that price target to $40 from $90, with the expectation of reduced visibility and ongoing competitive threats to continue to be significant overhangs. Those shares down 27%, their worst day on record. Next up, let's take a look at BTIG swiping left on Bumble, cutting its recommendation to neutral. Much like rival dating platform Match Group, the analyst says it's going to take a long time for Bumble to get its growth and sales back on track. He cut his 2025 revenue estimate by close to 20%. Nevertheless, Bumble bucking that trend, up about 3.5% on the day. And finally, let's take a look at Burlington Stores. An upgrade today to buy over at TD Cowen and a price target going up to $279. The analyst saying that the off-price retailer is making inroads on its strategy to drive operating margins. He also says the company's plans to open more stores as well as its supply chain advancements can bolster the sales outlook into next year and beyond. Burlington Stores relatively unchanged on the day, and those are some of our top calls. We do want to say in the retail space because that could be a big driver of market activity next week. We're expected to get results out of big box players like Walmart and Home Depot. And the big question on everyone's mind is how have they navigated softer consumer trends? Joe Feldman joining us right now, Senior Managing Director and Assistant Director of Research at Telsey Advisory Group. He's got to outperform on Walmart and a market perform on Home Depot. Let's start off with Walmart here because this is always a stock that everyone says technically should be recession-proof. It appeals to a lot of different income levels, and when things get bad, a lot of us flock to Walmart. Are we going to see a repeat of that in the months and quarters ahead?
Yeah, I think we've been seeing that for a little while now, Romaine. Walmart has performed quite well. They had a stellar first quarter. We think second quarter, when they report next week, is going to sound pretty good as well. And they're just so well positioned for this environment heading into the holiday season. The consumer is looking to save money. They're considering ways to stretch their dollars between paychecks. And Walmart offers that for the consumer because they have great prices, the best prices really on the market on food and consumables. At the same time, the discretionary offering that they have is also value oriented. And I think they're really well positioned in this market.
When does their investments, say, in technology and also wage increases start to become more of a headwind for Walmart in terms of profitability?
Walmart's been doing a lot of investment for a while now. They've even pulled forward some of the investment last year and then early this year. So we're starting to get to that point where that's that flywheel that Walmart always talks about, where it's a virtual cycle when you start to get better profitability, should start to come. I think the second half of this year, we're going to start to see some of it. 2025 should look even better because a lot of that investment, the heavy investment, has already started to happen. It's not to say that they're done. There's definitely going to be a lot more on the tech side and across the organization to leverage technology throughout the organization will be spent. But they're well positioned right now.
All right, let's turn to Home Depot because a totally different story over there, Joe. We're already sitting on something like 6 straight quarters of revenue declines, and at least based on the consensus estimates on the Bloomberg terminal, it's going to be a 7th straight quarter of declines. What are you expecting?
Yeah, we, like others, are looking for a decline this quarter as well. Certainly on the same-store sales side of things, I think the consensus around -2 right now. It's been a long time since we've seen that positive trend. We've seen fits and starts. We feel like we're getting closer, but I think you really want to see the Fed cut interest rates for this one to work. The stock has performed better every time we've seen an inkling or some suggestion that the Fed is closer to cutting, which they are pretty close right now. So the stock will probably work ahead of how the fundamentals hold up, but others in the space have had pretty challenging second quarter with regard to fundamentals, and it's been a tough spring, I think, for some of the retailers in home improvement.
So, Joe, I know we're getting towards the rate cut then. If we get 25, even 50 or 75 this year, is that enough?
Well, I think it will help. It will certainly, it's a start. I think the investment community would like to see more than that over time, but that would help get the stocks going. When we've done analysis in the past, and anytime the Fed has started to cut rates, within 3 months, 6, 12 months out, the interest rate sensitive stocks within the consumer world have tended to perform quite well. So Home Depot, Lowe's, Floor & Decor, those types of stocks should do well. But again, there is a trickle, a little bit of a lag or delay before the fundamentals where sales at the store really start to accelerate.
Yeah, so not quite there yet. Hey, Joe, we appreciate it. Thanks a lot. Joe Feldman over at Telsey Advisory Group. We appreciate that. Can we stay with consumer stuff for a second? We got shares of Sweetgreen, Expedia, and Honest Co. all moving a lot higher. So, okay, we're kind of not into maybe buying makeup, but we will definitely buy things like diapers, expensive salads, and vacations.
Yeah, kind of interesting to see. Of course, some of these stocks, or at least with Sweetgreen and Honest, maybe a little beaten down, so you get a rebound there. Kind of curious about the rebound in Expedia, I guess, because we were all talking about gloom and doom in travel, but I guess some people are piling back in. One that's not on the screen that I'm just going to mention here is that Intel shares down again. They were already down before the show started here. We're now learning that they've canceled this innovation event that they had scheduled for next month. Of course, that's on the heels of an earnings report that was no bueno.
No good. Mentioning the words liquidity and worried about that. That's pretty brutal for that company. All right, well, coming up, we are going to break down what to expect from the Fed. We get CPI next Wednesday. Remember, we were going to have an inter-meeting cut. Well, that seems to be off the table. So how do we manage and where do we go from here? We're going to break that down for you. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
I'm Alex Steele. It is a really calm Friday considering the tumult that we've seen over the last week. Volume is really light as well. Stocks pretty much going nowhere. But this time last week, when I was talking to Scarlett, it was 50 basis point cut in September from Citi and JP Morgan. It was a risk of an intra-meeting cut, as JP Morgan was also pointing out. Yeah,
it was a little bit of freak out, if you will. I don't know if that's a technical term or not. And maybe that's come down a little bit. I mean, if you look at work pricing on the system, it looks like people are still pricing in multiple cuts through the rest of the year, but not quite that full 100 basis points. But it raises the question, too, about kind of the next catalyst, right? Because this was all kind of driven, well, started initially, of course, because of some of the economic data. But we get some more economic data next week, including PPI, CPI here in the U.S., as well as retail sales, which I'm more interested in than the actual CPI data.
Well, not even that, but I feel like initial jobless claims just became that much more important.
Actually, we saw this last week.
Yes, the market moved. I think it's strange, but I'm not the one trading the market.
What's next? So we're going to be trading off the beige book?
Maybe. I don't know. Or the unemployment number in the beige book or something like that, or the minutes. Gregory Daco is EY chief economist, and he joins us now for his take. So is this our fate? Sort of the moves that we saw in initial jobless claims, this is how we're going to react to CPI, PPI, all the data points now?
Unfortunately, that's the situation right now. Even though the Fed and Fed Chair Powell have been saying that they're not data point dependent, that's the market's interpretation of how the Fed is reacting. Every single data point is overly interpreted. And we know there is a lot of volatility in economic data, including in jobs reports, but even more so in initial claims for unemployment, so that it's a little bit risky to try to interpret the overall sense of direction with 1 week of data or even 1 month of employment data. I think if you look at the broader picture, we are seeing an economy that is gradually cooling, gradually decelerating, with inflation moving towards 2%. And we've been saying for some time now that it's time for the Fed to start recalibrating monetary policy. The longer it waits, the more it falls behind the curve.
So for next week, what's going to move? Is it going to be the CPI, PPI, retail sales? Like, what's going to be the trigger, you think, for markets? Or is it just going to have to wait till Jackson Hole?
No, I think first and foremost, we'll be paying very close attention to the inflation developments, right? We're anticipating that the CPI index rose a couple tenths on the month, core CPI as well. That would essentially bring headline inflation towards 2.9%, 3%, maybe down a tick relative to last month, and core inflation down also a tick to 3.2%. So still moving in that right direction with indications and signaling that the PCE gauge, which is the Fed's favorite gauge for inflation, is moving closer and closer to the 2% target. So that's really going to be the main point of focus. Then you have the PPI data as a good indication of margins and markups that businesses are imposing. And then you have a reading on retail sales. How are consumers spending? Are they being more prudent? I think we'll see more evidence of prudence, especially on the lower income families.
Well, let's talk a little bit more about that, because we've kind of gotten a preview from that, at least based on some of the corporate earnings that seem to suggest that. We saw that with a lot of the travel sector, with some of the hotels and Airbnb, the airlines, Expedia, if you will, all suggesting that. You saw that with apparel makers. You saw that with food companies and restaurant companies, Gregory. I mean, if you believe what these CEOs and CFOs are telling us, we are already pulling back, and it's not just poor people doing it.
Yeah, I mean, we have a unique vantage point here at EY that we talk with a lot of CEOs, CFOs about how their business activity is doing. And what we've been hearing for some time now is that there is really a bifurcation of the consumer outlook, where you're seeing some consumers still spending freely, those at the higher end of the income spectrum. And then the lower income, more debt burdened families are struggling to pay for these higher costs for goods, for services, and they're the ones exercising more prudence. And that's why you're seeing this gradual slowdown in consumer spending activity. It's not a retrenchment. We're not headed towards a recession. We're certainly not in a recession right now. But if you look at disposable income, real disposable income, it's been growing at about a 1% pace, while consumer spending has been growing at a 2.5% pace. So that delta is filled in by people using their savings to finance their outlays. That can last for some time, but not forever. And that's why we're anticipating an ongoing slowdown in consumer spending activity.
Could a Fed action change sentiment, consumer sentiment, that is? I mean, I guess what I'm asking is, if Jay Powell comes out in September and cuts rates by 25 or 50 basis points, is that really going to materially change how people feel about the economy?
Yeah, I think generally speaking, yes. I mean, right now we've seen a slowdown that's essentially been engineered by the Fed. Tighter monetary policy, restrictive monetary policy has not simply made the cost of capital more expensive for businesses, but it's also done the same thing for consumers. So both from a consumer perspective as well as from a business perspective, if you have a high cost and high interest rate environment, you're going to tend to be careful with your investment decisions, with your spending decisions. If interest rates start to come down, even if they do so gradually, that will be a signal that it's now time to be a little bit more loose in terms of credit and start spending a little bit more freely. It won't be the miracle solution that ends the slowdown, because we believe that the Fed is way too restrictive, 100 to 120 basis points too restrictive, given the expected outlook over the next 12 months. But it will be a good signal that businesses can start investing, can continue to invest in growth, and that consumers can do as well.
So does that mean you're looking at 3 25 basis point cuts this year, or more than that at this point?
Yeah, we're being very nuanced in terms of our outlook for the Fed. I know that many forecasters, many investors really priced to market when it came to the Fed expectations. You were talking earlier about market expectations for an intermeeting rate cut, 75 basis point cut, 50 basis point cut. You have to remember that the Fed is still quite hawkish when it comes to its policymakers, and that it remains excessively backward-looking. There isn't much of that forward-looking perspective. So unless there's a change in the perception, the framework from Fed policymakers, you're not going to see that rapid desire to start slashing rates. And perhaps what would be most important is for Fed Chair Powell at the upcoming Jackson Hole Symposium to regain control of the narrative and really highlight more of a forward-looking perspective where the labor market is more balanced and excessively restrictive monetary policy represents a risk for the economy.
All right, a lot to chew on this week, and certainly a lot to chew on over the next few weeks. Gregory Daco, have a great weekend. EY's chief economist there, setting us up for next week, where we are going to get those economic data points we were just talking about, and maybe that's a feed through the week after that into Jackson Hole, or maybe will Powell feel comfortable communicating something at that time?
I don't know. It feels like it really depends on where market pricing is. Like if we're back into that, 100 basis point cuts for this year, 125, he's going to have to say something to rein markets in.
I know we're supposed to be talking about the markets and the economy here. I'm just watching the breakdancing competition.
Oh my God.
And just say, as a child of the 80s who came up with the advent of hip hop and break, this is so cool.
Amazing.
To see this in the Olympics. And I'm just watching these people and I'm thinking, you know what my first thought was?
What?
Simone Biles would be great at this.
Oh my God, so good. But you know that they don't get the music ahead of time?
No,
that it's like random
but
music?
That's great, right?
It's so cool.
So they can't plan.
No, and then
that's
it's just
fantastic.
how good they actually are.
Yeah. All right. Well, thanks for indulging my
we're focused. We're
there.
super focused.
All right. We're going to focus back on the markets here before our producers get apoplectic here and take a look at one of the biggest decliners of the day. Invest in your face? Well, not today. e.l.f. Beauty plunging almost 20% here on the day. We're going to talk about exactly what rattled investors. It's our stock of the hour, and it's coming up next. This is Bloomberg. Time now for our stock of the hour. Taking a closer look at shares of e.l.f. Beauty, down about 15% here on a weak outlook, even after posting sales that topped even the most bullish Wall Street estimates. Jess Menton, who helps to lead our equities coverage here at Bloomberg, joining us right now on the big program. Kind of explain this here, because, I mean, if you look at the numbers, they weren't awful.
Right.
But then you look at the market reaction, and that seems pretty
It's hard to make sense because it beat on so many different metrics. So the reason, if you look at this, it did boost its annual sales forecast, but the problem was it didn't meet the midpoint range that analysts were expecting. Also, Lindsay Dutch over at Bloomberg Intelligence was pointing out that there was really tough year-over-year comparisons that it's dealing with. So that's part of the reason. If you look at this stock now, though, it's down about 14% right now, actually 15%. So still on pace for its worst day since March of 2020.
I was looking at those comparisons. I mean, you were talking like 70-80% revenue growth in the prior year's quarters, and this year you're basically at half that, which is still 30+%
really good.
is still pretty good.
Right. Well, also, like the e.l.f. has cheaper products. I don't mean cheaper in a negative way. It just means their average selling price is less than their peers, which in theory should be good in this environment.
It should, and that was one of the bonuses for them, because especially when, of course, we'll have another update on CPI next week, and they do have a category for personal care products that's within that. But when you look at this, that was part of the alternatives and something that really helped them, because that stock was actually up about 30% year to date through yesterday's close before this sell-off. But if you look today, not just this stock, but Estee Lauder, obviously a more expensive, so not exactly in the same competitive type category class, that's down about 2.5% today. Also, Coty's down close to 2%. So also, if you're looking at that space in some of the other companies that are in that kind of world right now, also getting pressure today.
Did you see that column that we had by Bloomberg Opinion, Andrea Felstead? It's kind of talking about the lipstick index. You know,
that's a great one. It's an economic index.
But
so
she's actually saying that might be broken,
indicator.
that index might actually be broken, because the way we purchase makeup and cosmetics now is just a little bit different.
Well, it was a little weird, because I'm sure Alex and I could talk, like during the kind of peak COVID, it's a little bit different when you're stuck at home and not buying those things quite as often. But that is one of the things where, if you talk to portfolio managers, I've had a lot of them over the years say, especially a stock like an Estee Lauder, that is something they always own, because they have different family members that they know. They're always going to buy certain personal care products in those types of categories.
Yeah, exactly. And I think the point also is that you buy lipstick when you don't have any other money, and you still want to feel good about yourself, right? But with COVID, to your point, I mean, I don't know. I was sitting at home with my masks on.
That's right. It was like different types of products that we were using, right?
But the point is, if I did all that, I still have some of those products, so I don't need to go out and buy more. Hence, e.l.f. is not having like 80% growth anymore at the end of the day.
Yeah. And especially those types of products, though, if you go in the store, I mean, they're dramatically cheaper than a lot of their competitors.
Yeah. All right.
No, that wasn't you in the
No,
pandemic?
it wasn't you, Romain?
No. Well, the funny thing about COVID for me was I actually learned how to apply makeup because we were broadcasting from home and I didn't have the luxury of a makeup person. And of course, they don't teach little boys how to put on makeup. So I was watching like YouTube tutorials with my wife trying to figure out, how to, get that smoky eye?
Right. I was like, please, until you're doing your makeup at like 3 a.m. in your really terrible lit bathroom so you can broadcast lighting from home before your kid wakes up. I don't know.
I remember that clip. I think your daughter came up while you were on TV. It was the cutest thing on Twitter to see that.
She did. She tried to take off my mic in the intro to the 7 a.m. hour. Oh, COVID. Look at those good times. But in all seriousness, Jefferies still estimates the global beauty market expanded between 6 to 8% between 2021 and 2023. So that's still pretty solid, and even slight moderation, though. You wonder how much that's really going to ding these companies.
Yeah, you have a Bloomberg World Cosmetic Index, actually, in the terminal. So BWCOSM is the ticker symbol. So if year to date, it's up close to about 6%. It's a little marginally lower today. ELF isn't actually in this composite, but a lot of the other companies we were talking about are.
Invest in your face. That's all I got to say. All right, Jess, we appreciate you. Thank you very much. Jess Menton joining us there from the Bloomberg Equities team. Coming up, we're continuing to count you down to those closing bells. We got 15 minutes to go. Volume super light. Equities on the upside. You're looking at a solid 2-day run for the S&P, but it's really been an incredible 6 trading day over the last 8 days here for the S&P. David Sowerby, managing director over at Ancora Advisors, will be joining us. S&P is up by about 0.5%. The Nasdaq up by 0.5. Dow Jones Industrial Average up by 0.1%. This is the close on Bloomberg.
The U.S. economy is slowing, but nowhere near recession. And earnings, by and large, are coming in okay, consistent with a soft landing. And that's what we need to continue to focus on, is that a soft landing is just that.
Lisa Shalett there, the Chief Investment Officer over at Morgan Stanley Wealth. She kicked us off to the close just about 10 minutes ago, with about 10 minutes to go into those bells here. And kind of interesting, too, because we're talking about economic conditions and we talk about this rebound in stocks today, but you're not necessarily seeing that in the more economically sensitive stocks.
No, which also raises the question, too. What did we see this week? Like, was it technical or was it economic? Like, did we see an actual growth scare? Hence, the economically sensitive stocks maybe not doing as well, even though, the Russell's not down too much. But, or did we see something really technical that was disguised as something else?
Yeah, I don't know. I mean, I feel like if you pose that question to 10 different people, you're going to get probably 8 different answers.
Why you get a market?
And, but I mean, I think it was maybe all of the above, right? I mean, maybe it really was a growth scare kind of mixed with, obviously, the CTAs kind of bailing out. And then, of course, this whole unwind of the carry trade. I have no idea how much credence there is to that, but a lot of people seem to think that was a big part of it.
Yeah, and then you have on the other hand, though, some are saying, look, if you did have a real growth scare, why didn't corporate credit spreads blow out more compared to where the VIX was at like 60, 65? Why didn't we have more of a sell-off there?
Larry Summers said that? Larry Summers said that?
I don't know. I said some people
say.
Oh,
some people.
Yeah.
I thought you said Summers. Oh,
no.
I was like, really? Okay. Anyway.
Maybe.
We love him. All right. We also love our next guest here, David Sowerby, joining us right now, Managing Director and Portfolio Manager over at Ancora Advisors, with about 8 minutes until those closing bells here. And we talk about this wild week, David, but I think we kind of have to go back a little bit further, kind of to early July. I think it was like July 11th when we started to see a real rotation take shape. And then you had, I guess, just maybe a week or so after that when you saw the S&P really start to slide toward those correction levels. And I guess my question is, when we're trying to suss out whether this rebound that we've seen can sustain itself, which one of those dates was probably more important for the market?
Romain, by far, it's that July 11th rotation. The average stock in the S&P 500 is positive. The Magnificent Seven are down about 15%. I'm not sure I'm ready to call it a great rotation yet, but I think it's certainly a take heed rotation for investors, because when you start to see this rotation, it can extend for 2-3 years or longer, as we saw post the rotation in early 2000.
Do you have confidence to buy into that rotation given what we learned over the last couple of weeks about economic conditions?
I do. I think if you want to be navigating anywhere, small caps are mildly positive when, again, those Magnificent Seven are down double digit. Their valuations sit at some of the most attractive in 20 years. earnings in small cap are starting to reaccelerate. We'll see at the end of 2024 that the average stock is coming close to the growth rates that are seen in a Mag 7, probably in that 10 to 14% range. So I think it's got strong legs left in it.
So that seems like it's a buy the dip kind of setup, David, for you. Is that true?
Alex, I think that the second date, the peak of the actual market on July 16th, we know that 10% corrections are never over and done in 30 days. They usually take about 2 to 3 months to settle out. So I think we have to grind through this current environment, add in uncertainty of elections, talk about Federal Reserve independence or not so much independence. We can weigh in on that. So you've got about 2 to 3 years of trying to get back to those levels of July 16th. But I'll stand by that July 11th rotation. I think that's much more meaningful.
You also work with institutional funds, and I'm interested in what sentiment is like right now and how you look at that as an indicator.
Institutional funds, for example, out of bankruptcy, I chair the City of Detroit pension fund. I think what we're trying to find is just meet our liabilities, look for assets that are going to grow above average. U.S. public equities are still, I think, the place to be, closely followed by private credit in the United States, bank loans in particular. I think that's the second place to be. Non-U.S. still trails U.S. markets. That's been the case for the last 25 years. U.S. markets have compounded 4 to 5 basis points better per annum. That's where I think institutional investors are migrating, and they're starting to migrate more, looking more at opportunities in small cap and in value.
When we talk about then how long this plays out, and you kind of gave some good, interesting scenarios about how the rotation could last maybe a couple of years here, does the Fed or the potential actions by the Fed, I should say, is that going to complicate things at all? Because you have a market that thinks not only are we going to get 3, maybe 4 rate cuts before the end of the year, but they think that rate cutting cycle is going to extend deeper into 2025.
To the Fed's credit, they've got inflation rates at 3% or slightly lower. It was just roughly 2 short years ago that Chair Powell gave that famous Jackson Hole speech about the Fed's recommitment to low inflation, and they simply missed it prior to that with excess money supply growth. But since that Jackson Hole speech 2 years ago, markets in the beginning, they sold off about 10%. But they're up more than 30% since that August 26th speech of 2022. I think that gives credence to the Fed and why we need to have inflation rates low, why the Fed needs to stay decidedly independent. And I think the Federal Reserve's on course for some easing here in the near term. But the key is get those inflation rates at 3% or less. That delivers above average stock market returns.
All right, David. Be safe. Have a great weekend. David Sowerby, Managing Director.
My pleasure. Thank you.
And Portfolio Manager over at Ancora Advisors, counting us down to these closing bells. We just have about 3.5 minutes until we get there, Alex. There was some headline crossing the wire here on some of the weather conditions that we've been seeing really across the country, but specifically up here, up and down the East Coast.
Yeah, just to let everybody know, New York Governor Kathy Hochul declared a state of emergency for New York because we have severe flooding in communities all throughout the area. The storm is currently moving northeast, and the governor has said that she's sending in local rescue operations, and the state stands ready to support localities with any and all resources. This is like one of my biggest fears. Did you know this?
No.
Being in a car in transportation in the middle of a flash flood.
Yeah.
This actually causes me anxiety to have to worry about this going
serious
home.
stuff here. So be careful out there, folks. And of course, all those folks down south, too, that, of course, still being battered by some of the storms, the remnants, of course, of the hurricane that swept through. We go back to the markets here to wrap up what has been a wild week with the Dow and the S&P and the NASDAQ in the green, the Russell and the Dow Transports, though, holding in the red. The net effect of it all, though, Alex, is at least for the S&P 500, is on a price basis, we're pretty much where we were when we closed out last Friday.
It's kind of unbelievable.
I know, which is like if you were asleep for a whole week,
yes,
you would never have known anything actually transpired over the last 5 sessions or so. We're going to explain some of the moves that we saw this week, so stick with us. Full market coverage of all the week's action coming up right now, right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, here to help take you through the closing bell. A global simulcast. It starts right now. Carol Massar and Matt Miller joining us from the radio booth as we welcome our audiences across all of our Bloomberg platforms. That includes, Carol, our partnership with YouTube.
Yeah.
Quite an interesting end to quite a wild week.
Very unexpected, not exactly how I expected it to play out. I got to say, I'm exhausted in terms of the moves, the swings, the changes in the think, the emergency feel and panic feel on Monday, and it's kind of super mellow today.
I have always told new broadcasters, don't say the market's boring. You got to sell this product. But Romaine, it is not an interesting end. I mean, we're mildly up and we were mildly down this morning. Today is like the calmest day that we've had since last week.
Also, Carol, are you just tired? Because this is like hour 5 of you guys broadcasting together at this moment for today. But to that point, I mean, volume is really, really light. So you have to wonder if today everyone just put on their positions and just didn't want to take on massive amount of risk into the weekend. And then let's see sort of how futures open on Sunday. And then when you finally have the funds coming in on Monday morning in the cash market, what really transpires.
Yeah, and of course you have a lot of catalysts next week that could actually move this market as well. We've been talking a lot on the TV side, guys, about the economic data next week as well as a couple of key earnings reports, including out of Walmart, which should maybe give us some insights into the health of consumer spending, amongst other things as well. As we close out this week here, as we get the closing bells here in New York. Green for some of the major indices here after, like I said, what had been an incredibly wild week. We talk about a gain in the Dow Jones Industrial Average for the day, up about 0.1%, or roughly 50 points. Takes a while for these numbers to settle. The Dow still going to close lower on a weekly basis. The NASDAQ Composite is up by about 0.5% here on the day, is going to close lower on the week. And the S&P 500, 0.5% gain here on the day. And we were just joking, Alex and I here, that despite all the volatility, the S&P is unchanged on a weekly basis. So basically all that volatility, all that hand-rigging was for naught. The Russell 2000, as you can see there on the screen, down on the day by about 0.2%.
Yeah, I'm looking at the best performing names in the S&P 500 for the week overall. Axon Enterprise, the outperformer, up almost 25% on the week. Super Micro, though, at the bottom of the pack, guys, down about 18.5%.
All right, let's take a look at IMAP here. It gives you a nice sort of sense of where sentiment is. All you have to worry about is if there's more red or more green, and there's more green. There's some pockets of red in there too, but no surprise, it's communication services and information technology that are kind of leading the way higher here. Communication services up by 1%, Carol.
All right, let's get to some of the individual gainers, and I'm going to go to Trade Desk, which was, we saw it really an outperformer in the major indexes today, up about 33% here. Oh, wait, sorry. Let me go back to Trade Desk. Sorry, I was on Sweet Green. I kind of jumped the gun.
I thought so.
She's hungry. That's what that is.
I am. Trade Desk, forgive me, up 12.5%. This was an outperforming the major indices. Advertising technology company, folks, reported second quarter results, beat expectations, also gave an outlook that is ahead of the analyst consensus. Not a name we talk about, but this
such
is
a key, dude, when we're talking about Warner Brothers, when we're talking about Paramount, when we're talking about Netflix, this is a key name.
All right, dude. Thank you so much. Yeah, but it's not a name that comes up often. Expedia Group, I don't know how much you folks have been talking about it, but it's really interesting to see a lot of players in the travel space, Airbnb and others, some of the airline companies over the last couple of weeks, kind of talking about softening sentiment. And then Expedia saying the same thing. We were talking about it last night after the close. And yet, nonetheless, this one really an outperformer in today's session, up about 10% here at the close. And then now to the winner, the one that was up.
Sweet Green.
Up more than 30%. Alex was breaking it down last night, finishing up 33%. The company posted sales that outpaced market expectations, raised its outlook for the full year. So this one definitely easily an outperformer, although you said, only up about 20% from its IPO.
From its IPO. This 33% gain means that if you bought the stock at the IPO in 2021, you're finally in the money. All right, in terms of the losers today, Insulet shares are the biggest losers on the S&P, falling the most in more than 2 years. The company makes insulin delivery systems, and they expect a less steep ramp of new customers in the second half. I would have previously said, why? We're all going to get diabetes with our diets, but now there are GLP-1s, so maybe we won't. Intel is a big loser, and it has been a big loser for a long time now, but it's made worse yesterday after we all left this office. office. Moody's came out with a downgrade to their senior unsecured debt. Moody's says it reflects their expectations for Intel's weaker profitability over the next year and a half, higher costs related to product manufacturing, unfavorable product mix, a weaker than expected demand in nearly all of its product segments, and continued market share loss. So not a great note out from Moody's on Intel. Finally, Gilead shares after the biopharma company said it had mixed results, or actually analysts said they had mixed results, but they did have solid tumor oncology a business there, so at least they're doing a good job in continuing to fight cancer, but they do face commercial and developmental challenges, so Gilead, one of the biggest losers on the S&P as well.
All right, guys, I'm taking a look at the bond market here because it's kind of, if you went back a week, you wouldn't have seen the turmoil that evolved this week in the bond market, but it's pretty solid. You got 2-year yield going nowhere fast. You get a little bit of buying in the back end there. You see the 10-year yield off by about 4 basis points. But you also had an auction. You've had a 3, the 10, and the 30. They weren't great. They were kind of meh, particularly that 10-year earlier in the week that kind of turned the market around. And you're looking at what? The 210 spread disinverted earlier in the week, and now we're back to a little bit of inversion. It feels a little bit like reverting to the old playbook, guys.
Ira Jersey said they were bad. Just so you know. Ira Jersey said the auctions were bad.
Well, did he say kind of 2 of the auctions?
He was talking about yesterday and the day before.
Yeah.
I say Okay, I'm a little bit, I want to couch it a little bit.
You're more optimistic than Ira Jersey, our lead rates analyst.
To be continued. All right, let's go back to one of the stories that Matt and I have been talking about, and I hinted on it earlier with Expedia. But there's a lot of warning signs, if you will, in terms of a lot of the travel players, whether it's hotels, whether it's flights. I thought this was interesting in this story. It talks about this one company, Embark Beyond, and they're a travel advisory firm, and they say that the average trip length is down 14% year over year, averaging 6.2 days rather than 7.8. And even among its deep-pocketed travelers, the word of the year is value, according to the company's co-founder. So people are looking for value when they go to travel, or they're kind of scaling back their travel.
Is that the dog airline, Embark?
Embark Beyond, they're a travel advisor.
There is a dog airline, right? I thought it was interesting that Expedia was up, 13% on the day, even though they came out yesterday with soft bookings, and we had bad news from Airbnb, bad news from TripAdvisor, kind of bad news from Disney parks. And
Ryanair
yet Expedia
has come out too. They're a discount traveler.
Yeah, but is this a kind of that blip here? And we talk about the performance of those shares on the week here. And I was kind of surprised by the rebound in Expedia as well as in Booking, but you didn't necessarily see that same rebound, Alex, in those other names. Hilton was still down 13% on the week, Marriott down 10%. A lot of the sort of the traditional hotel lines will really seem to be the ones hit the most.
Yeah, I also wondered too, it was already kind of baked in, right? That Expedia dragged down a little bit because of Airbnb and Booking. So I wonder if that was already there, which is a little bit of a rebound because it wasn't as bad as feared.
All right, you guys, I don't know if you guys have been watching the Olympics. Yes. I know you guys have a lot of TV screens.
Only the
in the radio booth here. Well, the breakdancing is over. The woman from Japan won, Ami. She did a great job here. The men are tomorrow here, and that was fascinating. But this is it, guys. The Olympics wrap up this weekend. I don't know what your favorite moment from this Olympics has been so far, but it's there you got it. Simone Biles. How about that?
She's the best. She's the best. But there was a great piece, guys, in the Wall Street Journal that talked about some people from different countries. You don't just get a medal, you get other stuff. And it follows one gentleman, Carlos Yulo, won 2 Olympic gold medals for the Philippines. He doesn't just get the Olympic medal. He gets a congressional medal, at least $350,000 from the government, a free set of headlights, fog lights, free wedding photography, haircuts, furniture. His driveway is repaved with asphalt, and I think he gets a car or something. That's awesome.
I think a lot of them do. I didn't realize that athletes actually get a lot of other things when or some of them do, when they win a medal.
They struggle through training and a lot of them don't make any money on the way up. So I'm glad they get free fog lights. My favorite moment has to be Djokovic finally getting his Olympic gold. This adds to, the most wins in majors for any male tennis player, and he finally gets this. He could, I think, happily retire at this point.
Yeah. Interesting, too. I just want to go back to the breakdancing because that's close to my heart, which was the first year. There's a great story in the Bloomberg Terminal about the next Olympics 4 years from now and the new sports that are going to go into that. Football is actually making it in, although it's flag football. But apparently NFL players will be allowed, at least here in the U.S., will be allowed to vie for to be on the Olympic team.
Here's my question. Can you call it football if there's also soccer? Because doesn't everyone but us call it football?
But you're talking
about,
you
play it with your feet?
No, he's talking about American football.
Yeah, right? I know, but can you call two things football? Because, soccer for the rest of the world, you play with your feet, and then we're doing flag football. Is that going to get confusing? Do we need to rethink this? Is it, I don't know.
No, we should call football, just call it soccer. By the way, remember when I ran into Fab Five Freddy downtown and he knew Romaine?
He did. He did know Romaine.
Everybody knows Romaine, guys. I got stopped in the street talking about Romaine.
What does he think about football versus football? Did I pronounce it right?
Football.
All right.
We're going to put that on a loop, Romaine, just so you know. It's going to be with you forever.
You can add it to all my other...
Cannot wait.
Bloopers.
All right.
Have a good weekend, guys. A safe weekend. Enjoy the closing ceremonies of the games. They've been really incredible to watch. All right, that's a wrap. We're cross-platform, radio, TV, YouTube, Bloomberg Originals. We call it Closing the Bell. We will see you again, same time, same place on Monday.
An incredible weekend, financial markets, a full breakdown of everything that happened when we come back right here on The Close on Bloomberg. Welcome back to The Close. I'm Romaine Bostick.
I'm Alex Steele. Quite a week that it was.
Yeah.
Today, though, a nothing burger. Let's be honest at the end of the day. Let's look at the S&P wound up closing out. We were up slightly right around the highs of the session, up by about 0.5%, along with the NASDAQ as well as the Dow Jones Industrial Average. In fact, the S&P is looking at its best two-day move run in 2024. The VIX calms down. We're still at 20, though, so still elevated. The 10-year saw some buying coming in pretty much across the curve, just maybe not the front end. And I just want to highlight dollar yen. It's not necessarily that safety play. It's now sort of where do we go with this carry unwind? Some are saying that 146 is now that level where you'll see even more carry trades unwinding. So do we get that? What kind of volatility can we expect, say, headed into that open this weekend?
Let's take a look at some of the individual movers out there. We start in the middle of the screen with Alphabet. You're looking at the weekly moves that we saw in these stocks here because not everything really rebounded. You saw some of the big tech stocks, particularly some of the Mag 7, really not able to get themselves out of the hole. Alphabet ending the week down by about 2%. Akamai, that was the bright spot on the day and on the week. It had more than a 10% gain on a daily basis, the best mover in the S&P 500, and a 7% gain here on the week. But Supermicro, this is going to be a big story heading into next week. Of course, a maker of data centers that are ostensibly sort of retrofitted specifically for that AI fever dream here, and the bloom coming off the rose, a 19% drop on the week here. And this is the fourth straight week of declines now that we've seen for Supermicro, fourth straight week of declines that we've seen, to be honest, right now in that AI space. But our top story really is that amalgamation of stories that drove the wild week in financial markets. It was a roller coaster ride, propelled by a mix of economic data, confusing corporate earnings, as well as that messy rate hike that we got out of Japan. All of that setting off a surge in market volatility from the Japan to the U.S. and every country in between. Here in the U.S., 1 week and 1 month implied volatility on the S&P spiked to the highest since at least 2022. Now, that tumult was no less for Treasuries, where a key gauge of bond market vol surged to just about the highest levels of the year. And you had a stock-bond ratio that reflects market sentiment, and that plunged to historically low levels as well. Citi's equity trading strategist says that it may take a while for volatility to stabilize based on historical patterns of VIX retracements. Now, the next big test is going to come next week with inflation and retail sales data, as well as earnings from some of the big consumer companies like Walmart. As for whether the broad market rebound will carry on, well, Bank of America's Michael Hartnett says watch closely some of those technical levels, specifically on the Philadelphia Semiconductor Index and the XLK Technology ETF. He says any break below that 200-day moving average again would imply a further drop of an additional 10% for the benchmark indices.
All right, wild week for equities. Also some distortions, as you were pointing out, in terms of futures VIX versus the actual VIX curve. Jess Menton, Bloomberg Equities Deputy Team Leader, is joining us. She's back with us to help break things down. I want to start with positioning in the options market, for example. Is the options market telling us that we're also complacent at this point?
No, it looks like more volatility is ahead just in general. So if you look at CPI day for next week, it's much more elevated than the average straddles have been positioned over the last 12 months. So right now, Citigroup's Stu Kaiser is actually pulls this data. So the S&P is implied to move about 1.2% in either direction on Wednesday when that data comes out. But he was pointing out how just in general, because everything is elevated, you can see that too with Jackson Hole when Powell's expected to speak. It's also kind of in line with that type of move, as well as NVIDIA earnings on August 28th.
So if that's the case, then have positions cleaned out enough, though, that we may actually have like a better read of, say, where the vol funds are, the CTAs, like is there more selling triggered to these events?
So actually, Rocky Fishman, so he covers what especially when you're looking at the options market and what the VIX looks like. So right now when he's looking at particular funds, and these are vol funds that have that type of exposure, usually when you see the VIX spike as high as that, you should expect more volatility ahead. But right now, if you look at the VIX, it actually closed around 20. So when you think about where it was as high as intraday 65 on Monday, I mean, it's come down tremendously. So right now, the reading of it is, especially when I'm talking to my sources, they feel like it wasn't spiking on panic. There were other divergences happening, especially when you think about a lot of the different technical things that were happening with the yen carry trade and how a lot of that was unwinding.
And you saw that in the futures where you had a much smaller move here, which seemed to imply that at least the perception of where volatility is going wasn't as extreme as what the VIX itself reflected.
Right.
What about some of the cross-asset volatility? Because obviously the VIX is specific to what we're seeing in the S&P, but when you look at some of the other asset classes, whether it's in fixed income or currencies, are we getting a similar reading?
So if you think about the 10-year Treasury yield, because that can definitely be a strong correlation to how U.S. stocks can perform. So from a technical type level, when it's below 4%, that would actually be more boding well for stocks, because above that, there's more room to run if, say, the 10-year were to go, because the other resistance levels are closer to 420 and then around like 433. So if you had a situation where you saw either that move, a big move there in the 10-year, that could actually pressure stocks pretty tremendously. And then when you think about, obviously, more of what's happening in especially in currency type of space, in the dollar and what's happening there, actually with the yen, a lot of traders I've talked to feel like when you're thinking about what happened, there's probably not going to be a lot more room for it to run because the Bank of Japan already stepped in. And there's also technical levels if you're looking at the USD versus the Japanese yen and where it is, because it briefly fell close to 140, and that was its lowest level since December of last year. And but since then, it's begun to move higher from that.
Have you found there's any real credence to this idea that a lot of the selling that we got, even going back to last week, that was directly tied specifically to Japanese investors basically bailing, or is that just kind of like somebody was just trying to fill in the narrative?
So that was a much bigger part than, say, people pointing at macro-related data, because that stuff started happening well before Friday morning when we got that employment report. Of course, I'm sure that was another reason to sell, but a lot of that started unwinding because we had the huge rally that Wednesday once we had Fed Chair Jerome Powell speaking, but then you also had the Bank of Japan with a key interest rate decision that day, too.
All right. Jess Menton, who helps lead our cross-asset coverage here at Bloomberg. A nice wrap up here of the week that was, Alex. And it gets to this idea here, too, of like, what are people going to start positioning for as you head into next week? Are they going to wait till we get that CPI data, maybe retail sales, or do you even wait longer than that? You wait to Jackson Hole or even wait until the next Fed meeting?
Or the election. So I'm taking a look at the VIX curve, and we re-rated that front end quite a bit. So it was a huge distortion, and we had a higher volatility on the front end than we did around the November election. And now we've seemed to come down, and now the volatility is really elevated for that election event.
Yeah, and when you look at commodities, I know you follow commodities a lot here. There was a lot of talk about some of the moves that we saw earlier in the week, particularly in oil, and I think it was in the industrial metals as well here. Does that become a factor at all?
I think that's a China story, don't you think, at the end of the day? I mean, just look at the earnings reports. Like any company that has exposure to China, whether across the board, luxury retail, whether it's skincare, whether it's car makers, like they're all citing that weakness in China. That's going to continue to be tough as it spreads to different sectors.
All right. We got a lot more coming up here on the show. When we come back after the break, it's time for our top three, where we break down the top three movers and shakers at the center of the day's biggest stories. This is The Close on Bloomberg.
season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
It's been a big week in politics, from President Trump's news conference yesterday to the VP pick on the Democratic ticket. So we do want to go to D.C. right now for Balance of Power co-host Mathieu. Joe, as we look ahead now, we've kind of reset. We've got a lot of momentum and a lot of enthusiasm in the Democratic ticket right now. What should we be looking forward to over the weekend and next week as we head into the DNC?
Well, you say reset, and that's probably true on the Democratic side. I think a lot of folks watching this are waiting for a reset on the Republican side, which, of course, just came out. This is a ticket just put together as well in Milwaukee with J.D. Vance now running with Donald Trump. But they're trying to coalesce around a message that fits the change at the top of the Democratic ticket. And we've heard Donald Trump, again, as you point out on that news conference yesterday, in a bit of a freewheeling mode here, talking about a lot of different things, not seizing on a message that has crystallized yet. We've heard about Tim Walz's military career, questioning his credentials and some of the claims that he's made. And all we hear about Kamala Harris largely is that she's, quote, dangerously liberal. You're going to hear talking points start to crystallize over the week ahead so they can match, obviously, the extreme amount of coverage and messaging that's going to come out of the DNC in Chicago. Yeah. This is still being looked at as a honeymoon for Kamala Harris. She's not done a news conference. She's not done an interview. And they're going to probably try to keep that going for as long as they can.
Yeah, I mean, she's certainly riding high in terms of attention and sentiment right now. And I guess a big question is how long that lasts. I mean, she's been out on the trail. And, Joe, I think we learned a little bit earlier that the current president, Joe Biden, is at some point going to join her on the trail as well. He's been kind of in the background ever since the announcement.
That's true. They're going to do it in Maryland, Romaine. So obviously they're going to be in an area that's pretty safe for Joe Biden here. But you're right. To be seen on stage together, the optics here could be a little bit challenging, but it's obviously not something the Harris campaign is going to hide from. I'm deeply curious to see what candidates down ballot do with Joe Biden when the White House offers that visit on the campaign trail in the months ahead. Remember, Romaine, they're giving him Monday night to speak at the convention that he was supposed to headline. And I don't suspect a lot of people are going to be tuning in that evening.
Yeah, that's going to be a tough road for sure. Hey, Joe, there's been some articles that I've read about the Trump campaign having to reset here and sort of getting its message across in the correct way. What's the truth in that? And how does that sort of relate to that news conference we saw yesterday?
Well, I think, again, he's kind of doing this in real time. He's trying out different nicknames for Kamala Harris. When it came to Tim Walz yesterday, he said he's been into a lot of different worlds, he said, that people may not be interested in. And he referred specifically to supporting trans rights. But I think they have to pick their battles here. Accusing someone of stolen valor and abandoning their brothers in arms is a big deal. And that's what J.D. Vance has been pursuing. Donald Trump needs to coalesce in the messaging around Kamala Harris. But again, until she sits down and does a challenging interview, holds a news conference, we're very unclear where a lot of her policy positions are going to be, if not Joe Biden. Is there sunlight on some of these issues? When it comes to Israel, for instance, the border, we simply don't know.
All right, Joe Mathieu, you can catch him at the top of the hour alongside Kelly Lyons for Balance of Power, a closer look at the world of politics as we sort of broaden out the program and take a look at some of the big people that have been in the news on the day. It's our top three, and we start off with a name most people aren't familiar with. Her name is Jane Simpson, but you will know who she's going to be working for. James Dyson, of course, UK's richest person, I believe, right? Worth about $20 billion. She's going to be running his family office. A nice gig.
Do you have a Dyson?
Huh?
Do you have a Dyson?
No.
Oh my God, it is life-changing. So my mother has never ever vacuumed her whole life, and I got her a Dyson, and now she won't stop talking about it. It is an amazing piece of equipment worth every penny.
All right. Well, you're contributing to his riches.
I know,
here.
I am.
$17.9 billion. You contribute a few $100 of that. That Jane Simpson, of course, will have to manage for him.
I just want big hair so I can get the air wrap. Anyway, I'm also watching Larry Ellison. The Oracle co-founder is buying the luxury Palm Beach Resort and Spa Hotel in Florida. We don't know how much that actually cost. The resort was recently sold by the Lewis family, who purchased it in 2003. And remember, Larry Ellison also bought a luxury hotel in the same Palm Beach area enclave for a mere 173 mil on a residential compound 2 years ago.
It looked expensive, just by the look of it. Here, he's been pretty prolific in terms of buying up real estate between obviously what he's got down there in Florida and doesn't he own like half of Hawaii or something ridiculous?
It's quite a bit, yeah. Mm-hmm.
All right, well, someone who maybe doesn't necessarily own New York in terms of financially, but certainly owns it in spirit, and that's Robert De Niro. He's been a big backer, of course, of this town, and more importantly, of this town being a movie town. Of course, he has the Tribeca Film Festival, but now he's one of the co-owners of a new movie studio, Wildflower Studios, opening over there in Queens. And anyone who's walked around Queens, the Bronx, Brooklyn, there's just been a proliferation of these sound stages now as they really try to make sure that New York remains central to Hollywood TV and film production.
I love this.
Yeah.
This is like such a nice feel-good story for someone who grew up in New York to have that.
That's right. You're a native New Yorker. I always forget that.
Like it's not all Law and Order, guys. Like there's other stuff we can do here.
And I mean, and it's cool too because we talk about this idea of whether we can compete with, Hollywood or Toronto or more than that matter what's going on overseas, and obviously maybe this gives us a little bit of a shot. When we come back here, we're going to take a deeper dive into the earnings season. It ain't over. We got major reports next week out of Deere, out of Cisco, out of Walmart as well. A full breakdown when we come back after the break. This is The Close on Bloomberg. Well, the bulk of this earnings season is over, but we still got some big ones up ahead. Deere, Cisco, Walmart scheduled to report next week. Potential market-moving earnings reports out of some of the biggest names in the world. Jess Menton joining us right now, who helps lead our stocks coverage here at Bloomberg. And let's start off with Deere here, because there hasn't been a lot of talk about this company. I mean, we got CAT, like 2 weeks ago or whenever it was here. So maybe that gives us a little bit of a glimpse into what we're going to hear.
And especially because it's an industry bellwether and what that signals towards the economy on the back of a volatile week that we've had in this span. So it's important to look at this. And if you look at its stock, actually, DE is the ticker symbol on this, is down actually about 13% year to date. So obviously underperforming the broader market. And then also when you're thinking about just what it means for the heavy equipment kind of space there in agriculture, a lot of it, especially in recent quarters because of crop prices, that's still been an issue. So people want to hear, especially on the earnings call, what are the plans for more cost reductions to try to help support that type of stock?
All right, so Deere gives us maybe a read here on what's been going on in farming, maybe even construction. We get Cisco next week as well.
We had news about Cisco earlier.
Yeah, and you talk about an underperformer here in the news today that they're cutting a lot of jobs.
So that stock down about 10% year to date. Off the lows, actually, today it dropped as much as 1.3%, but didn't actually close kind of flat. So it did come off the low after that report, but Reuters actually did report that they did plan to have a second tranche of these types of job cuts. So that's probably why the stock didn't fall quite as much, because a lot of times Wall Street does kind of welcome the whole cost-cutting type of efforts here. But still, it's something when you're thinking about network equipment type makers, they've had a struggle there. And then when you think of a company like Intel struggling as well compared to different players in the AI space that have really been boosted by that. So when you think about telecom type customers.
You can't imagine Cisco and Intel in the same conversation. We got to give it something good. We got to keep it moving here. I just want to get your thoughts here on Walmart because obviously we talk about the biggest retailer. I guess technically they're still the biggest retailer.
And one of the biggest, biggest grocer as well.
I know, right. Amazon will want to quibble with that. But this is like the ultimate read on consumer spending, isn't it?
And that's stock's up 30% year to date. So since May, since it last reported, been on a tear because wealthier shoppers have actually started to flock to this type of retailer. And that's important to see kind of the space there because there's a divergence when you're depending on what type of retailers you're talking about. Also, Home Depot is going to be reporting next Tuesday. So that'll give you an indication. It's had a lot of issues with same sales growth as well. So something to keep an eye on.
All right, Jess Menton helps lead our coverage here at Bloomberg. A closer look at some of those big earnings report, and she just mentioned Home Depot, so let's go right there. Laura Champine joining us right now, Managing Director over at Loop Capital Markets. And you cover a lot of companies, but I want to start with Home Depot because this is a little bit of a basket case. I was just taking a look at their, at least on the revenue side, they've had like 6 straight quarters of declining revenue. Are we going to see that again when we get the report next week?
I think we are, Romaine. I think it's going to be maybe even worse. So renovations have really dried up. We cover some of the companies that feed into it, that make appliances and flooring, and their sales are down, meaning down about as much as they were during the financial crisis 2 years in a row, which is just burning off the COVID demand, but interest rates having risen as much as they have is really hurting renovations.
So this is more about home sales, because you mentioned some of the other companies. I remember we saw the results out of Mohawk, which makes floorings and things like that, and a couple other companies, and they were also struggling here. So is the idea here until we see a better housing market? Is that when we start to see better performance out of Home Depot?
Usually when interest rates start to fall 6 months later, these companies' performance improves. Now the stocks move immediately, so I would expect the stocks to move even faster than the fundamentals.
When we talk about whether interest rates and how that sort of feeds into all of this, obviously we know there's a direct correlation with home buying and interest rates. The expectation right now, as I'm sure you saw, is that interest rates are going to come, the Fed rates are going to come down this year. We have already seen mortgage rates start to drift a little bit down here. Is that going to have an immediate impact when they start to come, or is it kind of a lagged effect?
It takes a while. Yeah. So it takes a while to feed through. A lot of these projects have long lag times. So Home Depot will still be selling Halloween decor. They'll still be selling light bulbs, trash bags. But those big ticket renovations, consumers plan those for a while. So wouldn't expect it in a quarter or two.
All right. Well, let's talk about some discretionary spending out there. We are going to get next week. We were talking a little bit earlier about Walmart. When you push out a week past that, though, we get TJX, we get Ross stores. I think Burlington is also in the mix as well. What are those results going to look like?
I would expect good things from them. Jess was talking about a trade down helping Walmart. It's really helping off price. So we think that Nordstrom had a pretty tough sale over the last few weeks. Macy's looks awful. There are 300 department stores closing this year. I think a lot of that demand is falling to TJ Maxx, Ross, Burlington, and we see them actually trending up in price points with better brands. I think you're going to have good results from them in a couple of weeks.
Is that a reflection, though, of a soft economy, or is this just the execution on the part of those individual companies?
It's both.
Yeah.
So the department stores have been donating market share for 20 years, but it really accelerates given the inflation we've seen and some of the capitulation at the department stores who've just been losing share so long. Traffic has dried up in a lot of those anchor stores from those old malls.
Are some of those discount retailers, are they seeing new customers, meaning the type of folks who wouldn't have normally gone into a TJX or a Burlington?
You know what they're seeing is those customers used to be occasional. Like they might drop in around the holidays if they have some things, some house parties they need to pick up gifts, but they weren't regular shoppers. I think they're seeing occasional shoppers, middle class and up, meaning plenty of six-figure incomes coming in regularly, monthly, maybe even semi-weekly, and that never happened before.
Do you think consumer spending, though, overall, at least on things like apparel and kind of more, I guess they're somewhat staples to a certain extent if you got to buy clothes for work or for your kids, but it's still relatively discretionary. Do you anticipate that consumer spending will be resilient enough that the numbers that for feeding into these companies, at least as what they've projected so far, are going to be met?
You know, I think that off-price will be good. Off-price is doing well in home, for example. Overall, though, I don't think these retail numbers are going to be great.
Yeah.
You know, we see a weakening consumer still under pressure from inflation. I don't think it's going to be a really merry earnings season this Q2 anyway.
What's going to be the best one, or at least what are you anticipating? Potentially could be one of the better performers in terms of the earnings reports.
I think Ross is really interesting because it's the cheapest of the three big off-pricers and normally has not seen this trade down. So I think it'll be more of a special catalyst for them. And their management is so conservative, they're likely to beat expectations.
All right, Laura, I have to leave it there. Have a wonderful weekend. You got a busy week ahead of you. Laura Champine, Managing Director over at Loop Capital Markets. A closer look at some of the earnings that we're going to get this next week and the week after. Some breaking news crossing the Bloomberg terminal for a couple of companies. One with Hawaiian Electric, which of course has been dealing with the fallout from those wildfires last year. We're now learning that the company expects a $1.7 billion loss. This is from the PAC, of course, to compensate some of the claims related to that. The company also adding a going concern statement to its most recent SEC filing here, saying that all fire trials right now suspended due to the settlement. We'll keep an eye on that. Also keep an eye on Starbucks, learning right now that activist investor Starboard has taken a stake in the company. Those shares up about 3% here in the after hours trade here on a Friday afternoon, a Friday summer afternoon with a lot of folks home as we close out what has been an incredibly wild week with the S&P, the Dow, and the NASDAQ trying to recoup some of the losses from earlier in the week on a daily basis. The S&P did do that, but on a weekly basis, not a whole lot changed. 5,344 is just about where the S&P started the week, and that is where it ends it. A big move low, what we saw in the Treasury space. Your 10-year yield firmly below that 4% level, and Bitcoin would actually drop down below that 55,000 level, clawing its way back up to about 61,000. A lot more coming up here on the big program. Stick with us. This is The Close on Bloomberg. Local businesses struggling to fill roles are turning to city programs for assistance with hiring. Now, here's the catch. These programs are tapping into asylum seekers, migrants, to bolster the economy and pare government spending. It's today's Muni Moment, and we're joined right now by the author of the story, Ella Cerrone, Bloomberg News Equality reporter. This was a very fascinating piece because we've heard a lot of chatter amongst economists, including the Fed chair himself, who've actually talked about the role of immigration on the labor market. Your story specifically looks at migrants and asylum seekers, and I guess legal ways that they're being folded into the labor market.
Right.
Give me an example of that.
Yeah, for sure. So a lot of companies and businesses are looking for folks who have what we call unskilled labor works. That's the cooks, and make no mistake, I think cooks are very skilled workers, but it's very different from the highly skilled tech workers who can achieve H-1B visas. So these folks only really have the asylum process, which then allows them to apply for federal work authorization about 6 months after applying for asylum. And so that's the pathway that a lot of these recent arrivals are starting to take. Cities are then tapping into it as a way to really create solutions for these tough problems of unemployment and tight labor markets.
You mentioned a cook, so like restaurants and food. What other industries are also taking part in this?
We've seen a lot of traffic here with regard to construction. That's always been the case for a lot of these migrants. They've been getting day labor jobs under the table, but now thanks to these federal work authorizations, they can get jobs above table, and that saves them or protects them from wage theft and all these other problems. That also helps employers make sure that the folks that they're hiring have certain certifications to make sure everything's safe.
Are these long-term programs? So, like, what happens? I mean, we're just going to keep these people on the payroll until they become, documented.
Well, so the bulk of these people are waiting out their asylum cases, which can take anywhere from a few years to, we've heard that some of them are on backlogs for up to 6 years, just because there have been so many folks coming in and trying to petition for asylum. The hope is that for the 3, 4, 6 years that they're here, they're able to pay their own way, which then alleviates the strain on cities who are providing services.
What about, did you see any sort of political backlash to this? Because we know immigration has been a hot topic in this country for several years, and it's been a huge campaign issue. So when you hear about programs like this, I mean, from a humanistic perspective, it sounds great, but I'm sure, as you know, from a political perspective, there are a lot of people that are going to be uncomfortable with this.
Yeah, from a political perspective, it's definitely a hot button issue. There's a lot of rhetoric flying around trying to demonize these folks, especially from the perspective of taking jobs from American citizens. The reality is that a lot of these business leaders can't find people to fill those jobs. So they're kind of stuck between a rock and a hard place. And so they're really just trying to find people who do want to work, who are willing to put in the time and work. And this is one pathway that several cities and states have identified. If employers are open to it, they are free to hire, to interview and then hire these folks. But it's not like they're earmarking these jobs only for migrants.
Gotcha. And so in some of the cities that you've referenced in the stories, like Denver, there was a city in North Dakota, right? Was it Minnesota, a few other places?
So Denver really launched a big program for folks. They're making these work ready. It's called a work ready program, and it's a requirement if you want to receive additional services from the city that you have to be enrolled in this program, at least one person from your household. We've seen indications from North Dakota as a state that they might be interested in tapping into this, or at least helping employers who would be interested in connecting with folks. But they're really taking a more intermediary or a conduit approach, especially given that North Dakota is pretty Republican. So they're finding ways to make sure that everybody's happy while still helping solve one of the lowest unemployment rates in the country.
All right. Well, this is great reporting here, and I really encourage everyone to check it out on the Bloomberg terminal. Ella Cerrone, a Bloomberg reporter. A great story here about some of the creative ways that certain cities and states are trying to find migrant workers jobs. One of the folks quoted in that story is out there in Minneapolis, and he has a real keen understanding of what's going on the ground. Erick Garcia Luna is the Regional Outreach Director over at the Minneapolis Federal Reserve Bank, which basically just means he gets to really go out there and talk to folks and really get a sense here of what they're feeling and, more importantly, what they're doing. Erick, thanks for joining us here. We want to kind of continue this conversation. And, like, what are you seeing there? Because we've already heard from some Fed members, including Kashkari, including from Jay Powell, who've talked about the impact of immigration on the labor market, the positive impact, I should say, on the labor market in recent months and years here. What does it look like out there in your region?
Well, first of all, thank you for having us here. I think you referred to it a little bit, right? Perhaps the most important job we have as regional economists at the regional banks is to try to understand the economy of the region, not only through that available data that's out there, but also by connecting with folks in the business and community. So as my colleagues and I traveled across the region, more often than not, business leaders will point to immigrant workers as part of the solution to address their labor needs. So that just made me curious to know how the states within the Federal Reserve's 9th district were doing. Especially being this far north, usually you hear about the impact of immigration in this country as a whole, or in states in the south. But this far north, there's also an impact from that. Immigration has been steadily growing, and therefore the participation of immigrants in the labor force. You referred to North Dakota earlier. In North Dakota in 2010, about 3% of the total labor force was foreign born. Today, that is 6%. So, that tells you a little bit that as the economy grows, as demand for workers grows, they are also filling some space there.
And I was looking at some of the data that you put out in your report. Then I saw the national average for foreign-born workers was somewhere closer to 18-19% or something. Where are a lot of those workers concentrated? Is there sort of one industry where you see more of them represented than others?
Particularly in North Dakota, we have heard anecdotally, and I'm in the middle of looking into more details as far as industry concentration. Some of them are actually in the healthcare and social services sector. That's not counting what type of occupation they're in. As an industry, they have a tendency to hire. That could be nurses, that could be support staff. We're hearing some working in taking care of the elderly. So that is happening a lot. And as a matter of fact, in North Dakota, as I was talking to some contacts when I was working on this particular piece, they will tell us that people are coming from East Africa, for example, the Philippines. A lot of doctors are coming in and filling those roles that they have open in hospitals. But they're all over. Your guest just referred to some of the industries in which they're most concentrated in.
Yeah, I am curious, and forgive me if this is kind of a dumb question, but obviously when we talk about immigration here in the U.S., we focus a lot on the southern border. I can understand why you would have a high concentration of foreign-born workers in some of those southern states, whether it's Arizona or even in California. You are obviously in a region that is far removed, at least from the southern border. I know you have a Canadian border up there here. Why are some of these foreign-born workers ending up in Minneapolis, North Dakota, and some of those other upper Midwest states?
The answer is a little bit more simple than you think. You have one immigrant in front of you talking to you right now. Word of mouth, or family connections, friend connections. We have a tendency to gravitate towards where their community is already established, where they are telling us there are jobs. So immigrants will have a tendency to follow, word of mouth referrals, if you want to.
And of course, you're not collecting all this data just because you're interested in it. Obviously, there has to be some sort of economic impact, maybe even a potential impact on monetary policy. Is there a way you can articulate that for me?
Well, when you think about the dual mandate that the Federal Reserve has, right, keeping an eye on prices, stable prices, and maximum employment, it's good to understand the composition of the labor market. I think it is as simple as that. Understanding what the labor market is, who are the players in the labor market, I think it is important. What those dynamics are, it is important. And that's the reason why I've become more interested in tracking this particular aspect of it.
Have you gone back in time and really looked at kind of like the past history of immigrant workers in the labor force and what that impact was on the labor market and the economy?
I have not. I have not taken a deeper look in that regard.
Do you plan to? Because there's been a lot of discussion here about whether this is positive for us or whether, again, if you look at it through a political lens, some people would say negative. But, you need that empirical data to make this argument less political and I guess more sensible.
I think there is a case for continuing to look at what the data is telling us. In this particular case, Census collects a wealth of data, taking a look at what the current population survey has out there. I mean, these are surveys of about 60,000 households nationwide, that can tell us what the labor market is, what it is made up of. And, immigrants are part of this labor market. So it is something that I am definitely interested in looking into. How far back, I don't know, because we are in a constant need to know what is happening today in order for us to be able to report to the public and to our leadership. Yeah. And we'll continue to look at that.
All right, Eric. Well, this is some great research. And of course, as I'm sure you know, a lot of investors are really keeping a close eye on this. Erick Garcia Luna, he's the regional outreach director over at the Minneapolis Fed, responsible for really tracking, analyzing, and reporting on all these aspects about the health of the labor market in the Fed's 9th district. All right, stick with us. A little bit more coming up on the close as we set you up for the potential market-moving events over the next week. This is Bloomberg.
Starting August 19th, Balance of Power is live in Chicago for the Democratic National Convention.
So we've got a race here, and the sprint begins.
We'll bring you breaking developments.
Vice President Kamala Harris closing the gap with Donald Trump.
And informative analysis, all leading up to special coverage Thursday evening, including Vice President Harris's acceptance speech as the Democratic nominee for president.
As president, I will show Donald Trump what real leadership looks like.
Tune in starting August 19th on Bloomberg Television. Billionaire Gautam Adani founded one of India's biggest and most controversial business groups. After being rocked by accusations from short seller Hindenburg Research last year, Adani is now preparing for the company's future in a real-life succession story. Meet the family members he's handpicked to take over the business as we deep dive into the facts and rumors surrounding the Adani Group. Inside Adani, a Bloomberg exclusive, replays all weekend only on Bloomberg.
As we finish out the week here on The Close, here's a peek at maybe some of the potential market-moving events over the next week. We start out on Monday with that OPEC monthly oil market report coming on the heels of the best week for WTI crude going back to February. Tuesday, we get those PPI numbers here in the U.S. That's going to come right alongside the NFIB Small Business Optimism Indicator, and we start to get that trickle of earnings in the consumer space, including out of Home Depot. Your CPI numbers are going to drop on Wednesday morning. We will have full coverage on Bloomberg Surveillance as investors position around that. They'll also be positioning around those retail sales numbers on Thursday. Jobless claims also dropping that day, as well as earnings out of Walmart and Deere. And then on Friday, it doesn't end. Housing starts and University of Michigan sentiment will drop. We'll have a full breakdown of all the market moves right here on The Close. We'll be back next week. This is Bloomberg.